What's up, guys? Welcome back. It's 10:20 on the West Coast, Wednesday before Thanksgiving. Having some technical difficulties with this iPad, which is why I haven't been doing as many of these lately. They're just such a struggle. I've been recording this for now 45 minutes, and audio issues and freezing issues and yada yada yada. The market's doing great. You know, it's kind of choppy for the Dow, which has cooled off a tiny bit after hitting a new high yesterday, and tech has just been taking back the lead. So, some interesting news today. Salesforce is in talks to buy Slack. We're being driven higher by Square and by Tesla. And one of the things that I want to do is we're going to equal weight all of these positions of stock down to about $3,100, which is Amazon is our lowest common denominator, about $3,200. We're going to reduce these positions down to be equal weight. We're going to raise cash, and then on top of those positions, they're going to be about $3,000 in cash, and we're going to do about $300, $350 of options premium on top of that. That will replace the stock that we have sold. Sorry, I cannot catch a break. Everything's driving me nuts today. So sorry to be frustrated. I can't get through a thought without something driving me nuts. Okay, so what I've done and what we've lost is I've put on two vertical call positions in Square and Tesla, and rather than explain those, I am going to just do it again with the different stocks. So we're going to hop into Amazon here. And we're going to look at this options chain, and on the left we have the calls, which are the premiums to buy or sell a stock at a given price by a certain time, and puts are the right to sell a certain stock at a certain price by a certain time. So if you think about driving your car, and if you want to go faster, you can either push the accelerator or remove the brake. So buying a call is pushing the gas, and selling a put is like taking your foot off the brake. You can do the same in reverse, and you can do different combinations of, whatever you want to do. So options give you a ton of granularity of how much risk you want to take, or how directional you want to be, or what you want to do with the premium. So it gives you can control more stock with less initial investment. So a couple just quick things to point out. Don't want to go super deep into options on this video, but just explaining. Okay. This particular TD Ameritrade has two different apps. They have their mobile app, their TD Ameritrade, their main app, which is better for the live stream. And they have Thinkorswim, which is better for options trading, but it's not great for the live stream. So I'm kind of figuring out exactly how I want to show you all of this. But for explaining things, I'm going to explain it with this platform. And then I'm going to go through, I'm just going to blast through, I'm going to reset the whole portfolio. So I wanted to explain this and show you exactly what I'm doing and exactly what I'm looking at. So this is called the options chain. And first we're going to decide what month we want to be in. I don't trade weekly options. There's not typically enough volume. Some of these big stocks like Amazon, they definitely have enough volume and you can trade them. But I want to be in the main months, in the liquid months. And you'll see the ones that are weekly or quarterly will be denoted as such underneath the expiration. And options, like I said, the right to buy or sell 100 shares of the stock by this expiration date. Where you want to be, where I want to be, I basically have reverse engineered a lot of the tasty trade mechanics of what they're doing. I want to be in the month that has between 60 and 25 days until expiration. And I don't want to hold options positions that have less than 21 days until expiration. When you get closer and closer, like the ones that are expiring 2, 9, 16 days from now, all of those have really rapid time decay involved, and the time factor is just so far against you that you have to be perfect if you're dealing with really short dated options. That's not what we're using options for. We're just using this as a replacement strategy to lower our cost basis and to increase our exposure to a stock without buying. For us to buy more Amazon, it's going to cost us $3,200. We're going to buy more Amazon for $300, and I'm going to show you how to do that. So we're going to go into January, 51 days to go. On the left we have the calls, on the right we have the puts. What I want to look at before I hop into the spread view is just delta, and a quick explanation of what delta is. Delta is out of a possible 1 or 100% certainty, and what it shows is the odds that this will end up in the money. So this view, we're only looking at 24 strikes. There's hundreds and hundreds of strikes for Amazon because it's such a high value stock. So a 40 delta option means that there's a 40% chance that the stock, that this option, the 32.35, will be in the money at expiration, but a 60% chance that it will expire worthless. So there's just a couple different ways to look at delta and what it means, how you can apply it to, just to control your risk and to look exactly, what your odds, like I don't want to open up the full options chain because this garbage iPad crashed last time I tried to show you that. But you can get 80 delta options, which means that there's an 80% chance that they'll be in the money, and they basically become, they're so expensive that they basically become full stock. They become synthetic stock positions. So what I want to do is I want to buy positions that are a little bit out of the money, like at least these 3200s, but probably 3300s once we go into this vertical view. And then we're going to finance that call position with a worse, we're going to make a bet for the stock to go up, and we're going to finance that in part by a worse bet from some other counterparty out there in the marketplace. So switching the strategy, we're just looking at the calls and the puts right now, and you can buy or sell them individually, but what I like to do is create a spread with a long option and a short option, and that defines our risk, and it just gives us a really clear picture of how we can be mechanical with things. So we're going to create a $10 wide spread, and we're going to do this in January. And what we want to do is we want to buy, we're going to go as far out as we have to please don't crash. Please don't crash. Okay. So we're going to go out pretty far. And you can see how many there are in the chain. And you can take as much or as little risk as you want to. Show me the... Sorry guys, like I said, this is not built for options, and their default view is just beyond frustrating. Okay, so price, we're going to go down and we're going to buy the $3 spread. So that's the 33.50, 33.60. So just to look at this, this spread is $80, call it 80 and a half. We're going to buy that, we're going to sell the 33.60. A $10 spread has a max value of $10. We're buying it for $3. So what we're looking for here is a move up in Amazon where the premium goes, where the long option is going to gain value faster than the short option loses value. And we'll see this spread premium go from $3, and we'll put, what I normally do, I'll buy $10 vertical spreads. I'll buy them for $250 to $350, and then I'll put, as soon as I buy them, I'll put an order to close the option at $7, and I'll let that work, and I'll try to double or triple my money in that spread. And if I get to that point, then I'll either roll them up in strikes or I'll roll them out in time. So let's if I get another notification on my other phone, I'm literally going to throw it out the window. Okay. All right, so let's hop over into our orders. We'll see that we haven't filled. Man, I had a really good explanation of this on Tesla and the price fill, but whatever. So the mid price is at $3. The system is going to automatically bid the lowest it can and go up in penny increments until it fills my order up to my max price. So it's going to automatically price improve me here. We're going to pay $3 for this $10 spread, and we're going to sell this $3 spread for $7. And remember, this is in increments of 100. So the $3 spread costs $300. It gives us control over 100 shares of Amazon, but only above this strike price and only before January 15th. So if we don't get a move up or before the date, we just lose this $300. So there's a lot more risk, but there's a lot more upside. So let's put this in, let's get this filled, and let's see exactly how much that improved us. So we filled at $2.95. So we bid $3 for it. We got it for $2.95. The Tesla spread, we bid $3.33 and we got it for $3.26. It just will automatically price improve. This is what we've done on the day, and then we're going to do this across the board where we're going to have 10 to 12 positions, and then with those 10 to 12 positions, there's going to be a $10 vertical call spread on top of all of them. So again, this view isn't great. I'm going to work on some things. I'm going to do exactly what I just did with all of these. I'm going to create $10 spreads, just a little bit out of the money. Everything's going to be in January for now, for the next 2 weeks. And then once we get, maybe 3 weeks, once we get into December a good bit, we'll roll those Januaries into February. So it'll just become part of our management. We'll have stock, and then we'll also have on top of that just a little bit more leverage applied to the specific name. So the other thing, let's see, I just want to make sure I didn't miss anything because I've had to record this a few times. So CRM is buying Slack. I don't know if I mentioned that again. Now I feel like I'm just repeating myself like crazy because I don't know what was on the lost live stream or what wasn't. We're going to open a stock position in here, but we're also going to buy these 270 280s. Once we reduce one of our positions, we're going to buy some CRM stock. So man, who designed this system? What a nightmare. All right. So that ended up filling at 279. So I'm going to hop into a different view really quick. I'm going to hop into a different live stream. I'm just going to keep hopping. Bouncing around in here. And these numbers are kind of all over the place. In the other platform, what I'm going to do really quick is I'm just going to blast all these out. I'm going to get all these positions down to 3K, and then we're going to layer the verticals on top. We're going to go from there. All right. Have a good day, everybody. Sorry for the lost live stream. Sorry to be kind of frustrated, but it is what it is. We'll keep it moving. Happy Thanksgiving.